Welcome to the second episode of the Strong Money Podcast. So we did come up with a name between the last one and this one. And I think Strong Money is a good fit for what we're going to talk about, everything that we're going to discuss on here, because it kind of plays into multiple different things. Strong Wealth is the name of our business. So it plays into that with the strong aspect. But then it also just, we're discussing money, and part of that, part of money is Bitcoin. Bitcoin is a money, alternative form of money, and really an alternative financial system. And so it plays into that as well with strong money, because we believe Bitcoin is actually a stronger form of money than the US dollar or than fiat currencies. So that's what we're going to be going with from here on out. Strong Money Podcast. And like I mentioned last time in the first episode, if you didn't listen to it, we're going to be discussing wealth management topics, traditional financial system topics and strategies that we use with clients on a day in and day out basis. And we're also going to be discussing Bitcoin and faith and how faith relates to money. Because that's something that's very near and dear to our hearts. It's very foundational to our business and our lives. And so we believe it's important to talk about, because your financial plan is incomplete if you are leaving out one of the most important things to you in your life, which being your faith. So today, we're going to be building off of episode 1, where we discussed what is money, and we kind of broke down how we landed on gold somewhat as a society, as a good form of money. And then we compared gold, Bitcoin, and fiat money on the different properties, that make a good money in a society. And we discussed kind of the evolution of money in a society from store of value to medium of exchange to unit of account. So this one is going to build off that in some ways. In other ways, it's going to just help kind of add some pieces to the puzzle, maybe to help you understand our current financial system. So that's what we're going to be discussing today, is how we got here to where we are now in our current financial system, how it actually works, which ironically is much harder to explain to somebody than Bitcoin. But that's probably, again, another conversation for another day. But yeah, we're going to break down, how our current financial system operates, and how that is actually detrimental to society as a whole, and detrimental to you individually and the goals that you want to achieve in your life. You ready to dive in?
I'm ready.
Awesome. So I think a good place to start, I mentioned in the first episode how everything fully clicked for me when I finally read the Fiat Standard by Seyfedin Ammous. I don't know exactly how to pronounce his last name, but if you just look up the Fiat Standard, it'll definitely come up. Highly recommend the book. It goes through essentially how our current financial system operates and compares it and contrasts it to Bitcoin and how Bitcoin operates. So that is really what helped me understand the problem, to then be able to view Bitcoin as the solution. Because if you don't fully understand the problem with our current financial system, then you don't even care to really entertain a conversation about Bitcoin, because you don't believe that anything's wrong. So why do we need a new money if we already got one, basically? So definitely highly recommend that book. We'll be kind of using the same structure as we go through this conversation. So where I would like to start is just the role of our central bank, the Federal Reserve, in our money. How they control the money supply, what kind of their objectives are. We could even go into how they came about. But I think it's a good place to start, because they are really the head of the dragon, maybe, if you want to think about it that way. And so we'll start there and kind of funnel down into the other aspects of our financial system. But Yeah. Do you want to start then on the Federal Reserve, what their role is, and let's just talk about it from a more factual basis first. I think is a good way to go about it. Just factual, kind of what they say their purpose is, maybe even why they're necessary. Go through that, and then we can discuss why we believe it's bad.
Yeah, for sure. Yeah, to me, the best place to probably start with that is just to define kind of the two primary roles. One, which is more fulfilled by the central bank, the other, which is more fulfilled by our government itself, the federal government at least, and that's fiscal and monetary policy. That's these are basically the two realms in which our system basically not operates, but can enforce things in our economy, on our kind of fiscal and financial world, so to say. And so the difference between those two, fiscal policy, that's more specific to our federal government. So that's more related to things like taxation. That's more related to things like spending of the government. And so that's the stuff we hear in the news a lot, right? Obviously, just simple income tax rates, taxes on capital gains, whatever the taxes are. That's really what fiscal policy is getting to. Is that, hey, the government is saying, hey, we want a portion of this. And so again, that is more the federal government's role in trying to regulate our economic system. And then on the other side of that, obviously the spending aspect of it too, and just what they're using those proceeds plus the other proceeds that they have, or bringing in, I should say, to then go and finance. So that spending is on things like Social Security, on defense, on a whole bunch of other programs, Medicaid, Medicare, that sort of thing. Anything the government wants to put money really towards. And so, when you talk about fiscal policy, that's really, again, that is more for our federal government that we're going to talk about. So the treasury, that's what you're going to hear a lot of that stuff. The central bank specifically, they are more in charge of monetary policy. So monetary policy really deals with two primary things. And, this is where it gets so stinking confusing is it's very simple to say, but the way in which they, enact these is where it really gets difficult. And honestly, we probably don't need to get too much into the weeds with it today, but neither here nor there. Those two primary ways that the central bank works. One is through interest rates, right? So the Federal Reserve sets what's called a federal funds rate. That is basically the base interest rate that almost all other interest rates are based off of. Not almost, but literally all. And that's not just the United States. That's globally. You could even say that foreign countries, for the most part, they're actually pretty well tied to what that federal funds rate is too. Yes, their central banks can they have latitude to go and do what they want to do. But at the end of the day, because our world is such a dollarized world, U.S. dollarized world, they're very much intertwined. So at any rate, interest rate policy is one of those. So that's why when you hear, who is it? Jerome Powell, right? He's the Federal Reserve Chair right now.
Yes.
So when he comes on the news and he's, talking, saying, hey, we're going to do X, Y, and Z with interest rates, that's really what they're saying. They're saying, hey, there is a federal funds rate. We're going to move that up and down, and that affects interest rates all the way down. That affects the interest rates you pay for your home mortgage. That affects your auto loans, business loans, HELOCs, any sort of line of credit. Really, it just has a cascading effects down there. And then the primary thing, which we'll get into interest rates somewhat, but the primary thing, that we're really concerned about is the money supply question, or the money supply aspect of central banking. And this is where a lot of obfuscation tends to happen. But the other primary role of a central bank is to manage the money supply, and that's how our economic system works. Is that they should manage that to try and kind of manage the economy as a whole, to try to maybe avoid the negative consequences of what a purely free market might otherwise allow. So they can kind of step in. So this is where
Right.
you hear things, at least in our space, like money printing, all that sort of stuff. But those four primary things, again, it's fiscal policy, monetary policy. Under fiscal policy, it's really taxation and spending by the federal government. Under monetary policy, you really have interest rates and money supply. Those are the four mechanisms in which our current system operates.
Yeah, so absolutely. As far as what I was taught in school about economics, here's what they would say to include what you mentioned. Their mandate is to balance inflation and unemployment. And
Mm-hmm.
so that's really how the Federal Reserve came about. Not really, but what they would say is the Federal Reserve came about to prevent economic crashes like we saw in the Great Depression. You know, the Federal Reserve was supposed to basically steer the ship in a way to where we didn't see, you know, crazy crashes or crazy volatility in the economy. They're supposed to smooth it all out, make it all flow beautifully, and they pay attention to inflation and unemployment as their two kind of markers of how things are going. And then to include what you said, the two mechanisms that they will say that they manipulate to keep things in bounds, I guess you could say, is the interest rates, like you mentioned, and the other one is reserve requirements. Like this is what this is just what they will say that's how they the two levers they pull basically to balance things out. So interest rates and then reserve requirements would be the other one that they would say. We'll get into all the other things that they actually do, like in real life, but that's what you would hear from somebody who kind of believes in this system, I guess. Or if you took an economics 101 class, that's what they would say. And so like Jacob mentioned, the interest rates, that is really when your bank quotes you on a mortgage or HELOC, like you said, they are going off of what the federal funds rate is. So the Fed says our rate is 5%. Well, the bank then will have to charge an interest rate above 5%, to be able to lend money out. And so when they adjust that up and down, that's why we see, oh, my mortgage rate is, I can get a mortgage for 8% right now when 3 years ago, like you were 2.75 or whatever you got, very low. And that actually makes a very big difference in the cost of your house or, whatever you're borrowing money for. And then reserve requirements is actually the amount of money that banks must keep on hand, and the amount of money they need to keep on hand versus lending out. So prior to 2020, I believe it was 10%, right?
Somewhere in
10%.
there. Yeah.
So basically what that means is if you deposited $10 into the bank, all they had to do was keep $1 on hand, or 10% of their deposits. So they could lend out $9 to whoever, and they had to keep 10 on hand. That's the story that they would tell. And again, it's really a facade, but that's what they would say. And then in 2020, they lowered that to 0, which is just mind blowing to I think a lot of people if they actually fully understand what that means. You're depositing money into the bank's lending it all out.
They can.
They can. So if we all went to the bank, there's actually no money there. There's no money at the bank. And okay, so those are the two mechanisms, I guess, that the Fed would manipulate to keep the economy on track. Essentially.
And I think one important thing with the reserve requirements is basically what they're saying is the supply of money, how they're really modulating that is through these reserve requirements, right? Because like let's say they had a 100% reserve requirement for banks. That means that every dollar that we deposited with a bank, they have to have in reserves. So they can still, maybe make loans or something outside of that, but like they have to have every single dollar of deposit on there. So when we talk about a monetary creation on that, you really can't. You can't create new money through that mechanism because we have to have all the dollars that we have on hand, right, or are deposited. We have to keep all of those. Now,
Yeah.
on the opposite
I
side,
mean,
that's
to
where we
use
start.
your example though, I mean, there would be no loans if it was 100% reserve
Yeah,
requirement. It,
true.
if they actually followed the reserve requirement, we'll get into what actually happens in real life. But if this is if how they said it works is how it actually worked, they wouldn't be able to lend anything out because you'd have to keep every single dollar there. But yeah, go ahead
Hmm.
with what.
Yeah. And so, all it really gets to is okay, if that's the case, then no new money can be created. And what we mean by that is okay, let's just say, let's use that 10% example. So we can, nine out of $10 can then go somewhere else. Those nine out of $10, that is new money being created. So that's where, yes, there's other mechanisms now that the central banks take direct action to create new money. That's
Mm-hmm.
kind of one of the changes in the modern era. But prior to that, the money creation was really more done by the banks themselves because the reserve requirements were less. So they could just lend out more. Okay, more money flows through the system. If, okay, things got too hot, we wanted to cool things off, then we're going to raise interest rates and we're going to raise reserve requirements. Those two things together kind of tame an economy and theoretically should tame inflation over time, right? Fed has this 2% mandated target of, okay, 2% inflation, for is what we'd like to target over the long term, which it's a whole nother
Mm-hmm.
can of worms. What even 2%, does what that, uh, means to our money, so to say.
Mm-hmm.
But that's really what it gets to is theoretically those are the levers. Okay, if we have an economy that's running too hot, so inflation is maybe higher, we can either or we can it's kind of an and or interest rates, raise interest rates, and or raise reserve requirements. If unemployment's raising, inflation's coming down, okay, then we can lower interest rates and or lower reserve requirements for the bank
Mm-hmm.
so that okay, monetary expansion can begin again.
Mm-hmm. Yeah. And so I think one good connection to make here, because I think very, very, very few people in our world today make this connection, but the Federal Reserve says it themselves. If you took an economics course, this is what they would say, that inflation is tied to the amount of new money coming into existence because exactly what you said, they can manipulate interest rates and reserve requirements to slow down inflation. So that means that if low interest rates allow more debt to come out or more debt to be issued by banks, the cost of money is very low. I can go get a loan and I have to pay very little interest. So I'm more likely to get a loan than if interest was 10% versus 1%. And so if I'm more likely to borrow money because the interest rate is low, well, then I am going to take that money that I borrow and I'm going to spend it on something. Okay. So that's how new money comes into existence. I borrow it and then I use it to spend. So if the Federal Reserve themselves is saying that when less people borrow money, that slows inflation because there's less new money coming into existence,
Mm-hmm.
then inflation is directly tied to the money supply. I posted something on Instagram like a few days ago about um, it was actually about universal basic income and how
Mm-hmm.
universal basic income would lead to universal basic communism is what I said on there. And people argue back that universal basic income would not cause inflation because what causes inflation is supply chain issues, and they're like, oh, it's just a demand and supply thing. If there's more demand and less supply, then the prices go up. And they blame everything else except for the root of inflation, which is the money supply. And our current system admits that through this mandate that they're talking about. If reserve requirements are higher and interest rates are higher, that means less new money's coming into existence, and theoretically inflation should be lower. Like, they are saying this. So it's not just Bitcoiners making something up and saying that, oh, inflation is caused by the money supply, and it's actually not. Like, no, even the current system is saying that's the case. So the people who don't believe that are just in, I don't know what world they live in, what land they're operating off of, or it's absolute delusion. Because if you did take an economics class, according to our government, they would say the same thing.
Yeah.
And that is just mind blowing to me, that people can't make that connection between inflation and the money supply.
Yeah, and I mean that's like you're saying, it is intentional, right? Because I think let's be specific here. It's basically there's a difference in the definitions that when we say the word inflation and what we mean, right? That's what we're getting at is when we say inflation. When me and you are saying inflation, we're saying monetary inflation, the increase in the amount of money in the system, right?
Well,
When
yeah,
someone else
yeah,
says,
but yes, but at the same time, monetary inflation causes price inflation, which is what people
yeah,
are normally speaking to when they say inflation. They're talking about their groceries costing more. We're talking about the same thing. It's just we're referring to this inflation is
mm-hmm,
causing, monetary inflation is causing price inflation. So
mm-hmm,
there's a direct tie between the two. You know,
yeah.
we could like, anyways, yeah, go ahead.
And so all I'm getting at is that is the fundamental disagreement with a lot of people is they don't agree with that paradigm that monetary inflation causes price inflation. They say that price inflation in and of itself is separate from monetary inflation, and even beyond that, for the most part, price inflation is a good thing. Like that's what I'm getting at is yes,
Yeah.
we understand it this way, right? What we've been
But
taught. Go ahead.
but no, but the thing is that is what the current system teaches, is that
Hmm?
monetary inflation causes price inflation. People who understand Bitcoin did not make this up. Like,
Hmm?
this isn't just a theoretical tie here.
Hmm?
By the Fed being able to manipulate interest rates, they're saying that they can expand and contract the money supply.
Yeah.
And they are directly saying that by expanding and contracting the money supply, they can control price inflation.
Hmm. Yeah.
That's what they're saying. And so it's not a paradox. It's not like it's both sides are saying the same thing. We are against the current system, but they agree that monetary inflation causes price inflation. You,
Yeah. Yeah, I'm agreeing. What I'm saying is just I think people in general have an idea. Like that's what I'm getting at is people don't necessarily see that connection. They just think of price inflation as this and monetary inflation as this, and they're not correlated, right? I'm not saying that's what's purported. I'm not saying that's what's said. That's the belief that's held. And I think, the thing with, our current system too is that what they're saying above and beyond that is that price inflation is a good and needed thing, right? That is one of the fundamental disagreements is okay, maybe we can agree on both sides that okay, monetary inflation causes price inflation. Where the
yes.
disagreement comes is that price inflation is a good thing and that monetary inflation is a good thing. The current economic framework says it's a good thing. What we're saying is that no, not necessarily is it a good thing, and there is an alternative way of operating. But prior to getting to that, I want to go back and touch on something because I do think it's important to just call this out. When we're talking about these reserve requirements that banks have, and we say that new money is created through lending, right, by commercial banks. What we're really saying there is that okay, we have a debt-based monetary system. That is ultimately what we're getting to is that our money is debt. right? Because it is all, at the end of the day, that is how it is created, is through a debt, through a financing mechanism. And I just think from a, from a spiritual aspect, this is where it gets to be a little bit interesting, because we talk about in Proverbs to I can't remember the specific verses right off the top of my head, but it talks about not being a slave to the lender type thing, right? And that's not
Yeah,
necessarily talking about our current monetary system. Certainly, there's other connotations there. But I
for
do
sure.
think that it is interesting to kind of understand that fully, because again, this is what maybe another premise that we should have started with all of this is that this economic framework that we're operating under is a fairly new development. In the last 150 years, basically, that this is really the way that we've been operating,
Well,
right?
really, if we say that we actually came off the gold standard in 1971, then okay, 50 years.
Right.
If
70.
you read the fiat, huh?
Yeah, 50 years. Sorry. I was thinking
Uh,
1950. Yeah.
but if you read the fiat standard, he actually makes the case that it happened back during World War One, actually in the early 1900s,
Yeah.
which I fully believe is when we actually came off the true gold standard. And then it was
Because they
basically,
suspended redemptions, didn't they? Or suspended the,
yeah,
at least the exchange value or something?
yes. Well, I can't remember. I'd have to go back and read it to know specifically who was involved. But essentially, because of war and unrest, they blamed that on war and unrest and said that yeah, you can no longer withdraw your money from the bank. So
Mm.
you could not go to the bank and exchange the paper money for your gold. Is what they said. And so they said that because the gold wasn't there like it should have been.
Mm.
They knew that. And they knew that if, okay, war's breaking out, people are going to get a little nervous. They're going to go and get their gold back. And they're just going to take it to their house and make sure it's secure rather than having it in the bank. And so the bank said, no, we're not going to give you the gold anymore. Good luck.
Mm.
And they did that because they knew that if everyone did go try to get their gold out, it's not there. And then they would have to admit that they had been printing more money and saying that, oh, it's all backed 1 to 1 to gold when it really wasn't, because they were using that new money to finance the wars.
Yep.
So
Yep.
we'll get into that deeper. But yeah. So, anyways, this has only been happening for 50 years.
Yeah. Ish. At least full on happening for 50 years.
Admittedly, yeah.
Yes, right. And this is again what we're trying to do here is just lay kind of the background for how things work. So this is kind of the, okay, yes, this is what used to happen. What really started in the last 20 years, basically from the financial crisis on. One of the newer developments, and you've probably heard this word, but I think it's important to understand, is quantitative easing. So, quantitative easing is really just an extension of, okay, affecting the monetary supply in some sense. So, it's kind of in the same bucket as this reserve requirements, aspect that we've been talking about that banks have. But really, what quantitative easing is the central bank themselves. So the Federal Reserve is going into the open market and buying assets from, most of the time it's from other banks, right? So they're it's not just, oh, hey, we're going to set policy. It's not going to set policy to say, yes, the reserve requirements are this and the interest rate is this. No, we are actually going to go into the market and to buy assets. And so, how do they do this, right? Where does this come from? Well, for the most part, they are just creating new money to go and buy these assets, right? And again, the premise behind quantitative easing is, well, if we don't go into the market and buy these assets, then this could lead to bad outcomes, to excess employment, to high inflation, right? So that's why it started during the financial crisis, is because basically what happened is, the financial crisis, the very quick on that is basically that, we got into trouble with the way that mortgages were put together and basically bought and sold and traded. And what I mean by this is, so when you take out a mortgage on your house, most of the time, the institution in which you do that with, you take that mortgage out, they actually are not the ones that are going to keep that mortgage on their books. So you're not going to go and pay that bank or that credit union or whoever you're doing this through. Most of the time, and this is why when it's like you've been paying through one website and then all of a sudden you're like, oh, my mortgage has been sold or changed, now I'm paying through a different website. This is what's happening. There's actually different people who are holding that mortgage on their books. And so mortgages are a traded security on the back end, right? So we take out a mortgage to go buy a good, but banks and other institutions are actually using that as a security. And really, the reason they're doing this is because someone can then hold that mortgage and then they theoretically get a guaranteed income stream, right? So if I would lend Mitch money and then I say, hey, Mitch, you got to pay me 5% interest back, I have a guaranteed income stream on that money from that lending. Well, a lot of people don't want to go through the mortgage origination process. It's a headache to try and do to make sure that people are qualified, et cetera, et cetera. But they do like a steady income stream that they're fairly certain that people are going to make payments on, right? Like these are our homes, so we're likely to make our mortgage payments. So this is why mortgages became a security. What then happened through the financial crisis is that, well, but there's still risk in owning just one mortgage, right? The risk that one person defaults on the mortgage is a lot higher than the risk of 10,000 people defaulting on their mortgages. So that's exactly what they did. They said, well, let's lower the risk by just bundling mortgages together. So instead of being able to necessarily just buy one mortgage, you could now buy a financial product that packaged a whole bunch of mortgages together, thousands, tens of thousands of mortgages in this case. And so the risk that you have towards one person or one borrower defaulting on that mortgage is much less, right? And so what actually then happened is they actually unpackaged these mortgages. So they would package the mortgage together. Those mortgages, they would actually give kind of a grade. Like these are A-class borrowers, these are F-class borrowers. Then they would package those class of borrowers together, sometime intermixing all of them. That would be a separate product that someone could buy and sell. And then even on top of that, they actually basically went and gambled on making bets on these mortgage products. So just like you can go to the racetrack or the horse track and make a bet on, hey, X horse wins the race, Y horse wins the race, financial markets can do the same thing. The mechanism is not the same. We're not saying, hey, this is the best performing asset, but you can make a bet on whether it defaults or doesn't default. So you can make these bets. And so ultimately what I'm getting to here is what happened through all of that. No matter that mechanism I just explained, what happened through all that is that a lot of very large institutions had a lot of risky assets on their books via these what they're called mortgage-backed securities, some other products, that were these repackaged mortgage-backed securities. They had a lot of risk unknowingly, and the only way to really make sure that all of those institutions didn't go belly up was just to buy those bad securities, buy those bad things from those institutions. So that's why, if you remember, during the financial crisis, we saw like the Lehman Brothers, the Bear Stearns, we saw AIG almost go under. I mean, these things were all these companies where, those couple went under, but then, outside of those, there is a whole sector of Wall Street that was very close to doing the same. And so the solution that the Fed came up with, instead of trying to manipulate interest rates or manipulate reserve requirements, is just, we'll buy those assets. That's what started basically quantitative easing. Is, okay, we'll buy those assets. What are they buying those assets with? Well, they're going to create new money to buy those assets with. And so this is where it gets confusing when we talk about the methods that the Fed uses to affect the monetary supply, because now this quantitative easing has morphed into much more than just that. And so it's morphed into much more of a complex beast where the effect is still the same. The effect is still that more money is being created into our financial system. The mechanisms that they're using to do that are getting more and more obfuscated. Some might say that that's intentionally because then they can have plausible deniability that okay, this is really increasing the monetary supply. Some would say, no, this actually isn't increasing the monetary supply because it's not necessarily creating new money, it's just buying assets. Neither here nor there. The premise is the same, that this is a new development on what we had previously talked about, which is why we've seen, during the last 20 years, we've seen the expansion of money increase, pick up, because they've had this new mechanism that was not in use necessarily prior to that, or at least to the extent that it was after the great financial crisis. And this is part of why, too, why we can go through like a COVID period where, we lived through COVID. What did we see? Yeah, markets dropped crazy amount in the beginning of COVID, but that lasted a couple months, if that. After that, what did markets do? There's a ton of wealth that was generated during COVID. Now, what was that from? Well, that was because the Fed was doing this en masse and implementing these methods en masse. And so what you saw is there was an exorbitant amount of new money being created through these methods. That money had to go somewhere eventually. And most of the time that went into financial assets because that's the easiest place to put them. And that's a whole nother part of what I'm sure we're going to get into is just the forced investment aspect. But, I think it is important to call that method out, this quantitative easing. You hear about it all the time. Again, at a fundamental level, it's just the Fed buying financial assets in the open market or from commercial or private banks.
Mm-hmm. For sure. I mean, and that is what bailout means. When you hear banks or companies being bailed out, it is the Federal Reserve creating new money, and in this case, buying these worthless securities from Wells Fargo or whatever, whoever else it may be. Because the issue is Wells Fargo is holding these investments, the mortgage-backed securities, like you're saying, they're expecting to get paid. And they're using that income stream that you described to operate, pay their employees, whatever. And when that income stream, what turned out to be fake, basically, the Fed was like, oh, we'll replace that income stream for you. And it doesn't matter that you did all of these essentially criminal things by, holding these risky investments or worthless investments. You basically knew they were worthless. We'll just go ahead and let you off the hook by coming in and saving the day. And that is what bailouts are, what you just said. So that, do you think that covers the Federal Reserve, or you think there's other things we should go into? I think now that I say that, I think one aspect that a lot of people struggle to understand is the national debt, what that means, and the Federal Reserve's role in that national debt as well. Our government intentionally spends in a deficit. They do it on purpose because they believe that if they overspend, that will put more money into the economy, and that will spur, demand. That will make us go buy things and grow the economy. And so they take on a bunch of debt intentionally. So do you want me, or you want to go through describing, I guess, how the Federal Reserve basically bankrolls the government in this operation?
I think you describe it well, so go for it. I like the way you describe it.
Well, yeah. So we all hear on the news, or on social media, whatever, government debt is at, or national debt is at 35 trillion. And everyone thinks, oh, this is a big problem. But they don't really know why it's a problem, for one. and they don't know how that problem actually affects them. So they kind of just ignore it. I even posted a clip a couple days ago of Theo Vaughn talking with Dave Ramsey, and Dave doesn't understand this either. But anyways, Theo Vaughn was saying that it basically seems like a fairy tale. He's like, it just seems so out there that it's like it doesn't even matter. Basically, like it's just like such a big number, and everyone talks about it, but nobody really does anything about it. That it just kind of operates in no man's land and doesn't matter. And so there's major downstream effects. But what I really want to touch on is how the Fed actually allows our government to always spend more than they make. If you and I spent more than we made, we'd run into some big issues. We would go bankrupt because eventually no one is going to give us more credit cards is what happens. You know, it's like, okay, if I bring in $5,000 a month, but I spend $10,000 a month and I put that extra five on credit cards, I will eventually max out the credit card, and I will continue to max out every single one until I will no longer be lended to because I can't pay it back. So I am a bad borrower, and banks and credit card companies will be like, screw that guy. He can never pay back his debts. We're never going to lend to him again. And so eventually I will have to file for bankruptcy because I cannot repay my debts. And then my financial life is essentially ruined because I will not be able to borrow into the future. I will have that on my credit report, and banks will never lend to me again. If they do, it'll be very high interest rates, and they will be very skeptical about doing it. And then I'm cut off from the banking system, essentially. But the government gets a free pass to do this. They spend more than they make every single year.
In every single presidential cycle. Doesn't matter if it's red or blue or if anybody else comes along, because that's everybody likes to say, well, it's the other party. Nope, it's both of them. It's this one side, or it's both sides of the same coin. That's all it's getting to.
100%. It's a system that operates regardless who is within it. That system will continue to force everyone within it, all of the individuals who make up the system, to act in the same way. There's no way that they could change it at this point without everything falling apart. And so the government gets a free pass to spend more than they make every single year, regardless if what caused them to spend more than they made was sending money to Ukraine or to Russia or to the Taliban or, whatever it is. If you or I didn't want them to do that, we have no say. Doesn't matter. Oh, you can vote for somebody else. Oh, we just said, doesn't matter who's operating the system. The system will still go on because that's how it's designed. It's designed to operate that way. It's intentional. It's not, just Donald Trump does it because he's a bad guy. No, they do it on purpose. And so what allows the government to do that is the Federal Reserve. The Federal Reserve buys treasury bonds issued by the U.S. Treasury. And so what that means is the Federal Reserve is lending money to the government so that they can go continuously spend more than they make on whatever it is. Doesn't matter if you agree or disagree. And I think a lot of people don't understand that mechanism. They see the national debt. They don't know what it is. It's like, how do they even, like, how do they even get this debt? Basically, it's like, it's like who is lending to them? And it's primarily, there is a lot of other countries buying our debt because we essentially forced them to. We won the world wars. But the Federal Reserve also does this. So the government's like, hey, we'd like to spend $1 trillion over the next month, and we need money to do it. So they just do that in the form of bonds. So they'll say, hey, we'll you buy this bond from us and we will pay you 5% interest. And, eventually it'll be paid back over however long the bond is. And so the
Yep.
Federal Reserve says, okay, great. No one else wants to buy these. No one else does, because us as the American people, we don't want to buy a U.S. Treasury because we don't trust the government and we don't want them to be spending our money. So we're like, I'm not going to lend you any money. That's what we're saying by not buying their bonds. I don't want to lend you money. But the Federal Reserve says, we don't care. We will buy them, effectively lending them the money to do whatever they want on a continuous basis. And so instead of the debt going down because it gets paid off, it continues to go up, effectively meaning that they are just taking out larger and larger credit cards to pay off the old credit cards. So they're like, yeah, we were in $1 trillion worth of credit card debt, and we're going to pay that off by issuing new bonds, AKA, I'm going to get a new credit card. And so if I can get a credit card that now allows me to spend $2 trillion, I'll pay off the old one and I'll have 1 trillion more of debt to go out and spend on whatever we want. And so that is effectively how the Federal Reserve bankrolls the government to do whatever they want, whenever they want. And there's not any consequences on them for constantly being in debt and spending more than they want. The consequences get thrown onto us.
Which
You,
eventually
me,
come back to bite them theoretically.
maybe. But anyways, so yeah, the consequences get thrown primarily onto the poor of our country, which we'll get into, or the poor of other countries. And so we'll get into that later. But I think that's another important mechanism just in this conversation of how our financial system works, so that people can understand how the government can just go into more and more and more and more debt constantly, and it never has to get paid down. It never goes down. It never will go down because they don't want it to. It
Yeah.
must continue to increase over time so that new money can come into the system over time, and that's what it grows the economy, so to say.
And so before, because I feel like we kind of have a turning point, before we do this, I think to try and recap what we just said,
Yeah.
through the last however long. So our economy, one of the fundamental beliefs of the way our economic system is designed is that government intervention in a otherwise free market society is a net good thing. The reason it is a good thing is because they can help us weather the higher volatility that might come with a pure free market economy. So a pure free market economy might mean that the booms of an economic cycle might be better, or greater, but also the busts. And so the premise is that by the government intervening in that through these methods that we've been talking about, that we are better off for that. That in a theoretical way, it can smooth the ride. So maybe the booms and busts are less. We can manage them better. Reduces the volatility of what a free market can provide. The methods in which they do that between our federal government and the central banks are, again, fiscal and monetary policy. We've talked about what that is. Fiscal policy being more on our federal government side, taxation, spending, even the spending on the things we're just talking about here. On the Federal Reserve side, it's more in the interest rate and monetary policy. Right? So they can set interest rates and they can affect the amount of money in the system through reserve requirements, quantitative easing, buying treasury bonds, as we're talking about here. Those are the mechanisms in which they have. And that is the way it's designed. Now, one of the things that we're going into is that probably, not probably, it really did help to build America into what it is. It's not the only reason. Violence is another great answer as to how America got to where it was on the world stage, but it's part of how it got to where it is because we basically backed our dollar, our currency, our what we used with violence, with our superior military power. right? And so this gives us a leg up on the rest of the world for multiple reasons. But prior to getting that, what I'm getting at here is it's our economy is designed that way for a reason. The reasons weren't necessarily historically bad. What has happened though is, and we've referenced this already in this episode, and we've referenced it before, is in 1971 or 72, we went off the gold standard. The gold standard was something that we tied us to some sort of physical reality with all of this. So what we mean is that all of these mechanisms that we've been talking about, fiscal, monetary policy, all that, at the end of the day, our money was still backed by a physical good, gold. It was still backed by physical good. And so that means that it was tied to that physical reality, even if that we were trying to lessen and lessen that. After 71, we are no longer tied to that physical reality at all. And that's where things have changed, and that's where we are now really starting to see the downstream effects of what that's meant for us. That is where we get to where we're at today, is that, hey, this economic framework likely helped us get to the place that we're at. Could a different economic framework have gotten us there? Maybe. We don't know. We can't go back and say yes or no. We can't relive history, but it's likely helped us to get to where we're at. But the differentiator in the modern world and what we're seeing today is that we no longer are tied to any physical reality in what we're doing. The only reality that all this framework is built on, and we talked about this in the last episode, is the faith of our U.S. government, the faith and credit of our U.S. government. That's what it said. That's what we are at now. Dollars are backed by the full faith and credit of the U.S. government. It is not an ounce of gold or a quarter ounce of gold or whatever else. No, it is backed by that faith. That works in a high trust society, a high trust world. Are we in that world anymore? I don't know. Is part of that reason because of these economic systems and frameworks? Maybe. All that to say that whole framework that we just described, that is I'm going to use the right word here, Mitch, Keynesian economic framework. I got that right? I didn't say that wrong?
Yeah. If you listen to episode 1, you'll hear him say Keynesian and I don't even know what else. But I literally just cringed every time. So I had to let him know before this that no, that's not how you say it. You've got the all of the details right except for the pronunciation.
It's
Anyways,
like in college when I went on my first internship and I kept telling the guy I was working to, or I was talking to him about the inventory instead of the inventory.
dude, what is it with you and mispronouncing common words? What did you say the other day? You said something about taught. It was taught, but you were saying taunt. That's what you were saying. You were saying that you pulled the fence taunt. And I'm like,
Yep.
What are you saying? You're not taunting the fence. Like taunting
That's exactly what I'm doing. I'm taunting the fence. That is the correct word. You're not going to convince me otherwise. Just like it's milk and not milk, or milk and not milk. It's pillow and not pillow.
Well, I'm on board with those. That's just our Midwest Indiana upbringing there.
The
but
rest of it's I'm just a little slow, so that's okay.
Those are like more like accents rather than just complete utter mispronunciations.
But taunt isn't taunt. That's just an accent. That's all that gets to.
Yeah,
It's like me.
in it.
It's like me saying what is it? Frustrated. I learned that from my parents. I just leave out the R in frustrated. It's frustrated, but I say frustrated because that's what my parents said. Anyways,
so we need to reprimand your parents.
Yeah, they're the ones. Hey, I read a lot. I don't
they probably
speak out loud.
They probably got it from the Amish.
Probably.
I blame the Amish.
Hey, Amish are good people. They
For sure.
get Bitcoin if they could use the internet.
Well, they're driving cars and have phones and everything else now, so they might as well just go ahead and do it. But sure. they would like Bitcoin. They would.
Yeah. So at any rate, all that to say, that is the economic framework, Keynesian economics that we have operated under. That's pretty much the framework that every other country in the modern world operates under. And part of this whole Bitcoin thing is just basically being open to understanding that there's actually other economic frameworks out there, and that should work. Now the reason why, so an example of that is Austrian economics. Maybe we'll get to it later. I don't want to go into all the details and differences now, but
Mm-hmm.
part of the reason and part of kind of the fundamental thesis for Bitcoin, part of the reason why we work under those a Keynesian model is because it allows the government to have more power over us. When the government can control our money and our money supply, that allows them power over us in our world, right? And,
Mm-hmm.
and, and so this is
And
why.
this may be a good point to just mention that we should have led with this before, but the Federal Reserve is not federal. It is a private institution that is supposed to operate completely separate from the government. The government is the one who put it into, or maybe there. I don't remember what the act was, but they put out an act that allowed it to become into existence, basically. But but it's not a government institution. It's
I think it was
supposed
just
to
the
be.
Federal Reserve Act, wasn't it?
Oh
I
yeah, I
think it
mean
was
it might
literally
be.
just called Federal Reserve Act.
Yeah, it might be. Um,
Yeah,
anyways,
19.
and so that is a common misconception, and that was actually something that was shown to me by that guy at Schwab that I mentioned yesterday on our call, which I don't think I had told you that story before, but that's important to recognize that it's supposed to be completely separate. Whether or not that's good or bad, it's still bad. But even if they were completely separate, but now that they're in cahoots, basically working together, and openly working together, like it was probably already happening, throughout history, but it's to the point now where they just do it right in front of you. It's like we don't even really care. We're gonna work together and do it right in front of your face because there's nothing you can do about it. Um, yeah, that's an important distinction to make. But then when you also look at who appoints the chairman of the Federal Reserve, the president, like how can you have something that is supposed to operate completely separately from the government, but the person in charge of it is appointed by whoever gets elected? Come on. And you expect it to everyone to believe that they operate separately, like, oh yeah, I'm not going to listen to whatever the president says I should do. Like that's the person who gave you your job. When your paycheck again depends on that person, you're going to listen and do whatever they say. Like that's what keeps you in control, keeps you in power. If you don't fall in line, then you'll be out, and the next guy who will be in. And it's obvious.
And that control and power aspect, and not specific to the role, but just in general with what we're talking about with this whole framework. I mean, that really is what it gets back to. It's a power and it's a control mechanism. And again, it's like these things aren't necessarily inherently bad, right? Even as Christians, we're called to submit to our leaders and to our governments, right? And that doesn't mean that we fully submit to them in every form or fashion, right? Like it doesn't mean we just
Mm-hmm.
like, yep, you're doing something horrible, so it is what it is. But we
Yeah.
are called to that, and there's a reason for that, right? Complete anarchy in a society. I know some of the Bitcoin space, the anarcho-capitalists, whatever. I would say for the most part, we don't accept that. Like a hierarchical form of society is likely good for us in some sense of the word, right? It's just what's happened is that power and control has now been perverted. And the reason it's been perverted is because it's no longer tied to any sort of physical reality, right? So when we talk about these money creation mechanisms, and that's going to be the big thing that we're going to hit on probably in the second half of this whole idea of monetary inflation, debasement. So the increase in the money supply that's deliberately decreasing the value of each unit of the currency.
Mm-hmm.
Like this whole aspect, right? That's what it gets to is they can use that to control, to have power over, and when
Mm-hmm.
that control and power is literally infinite, right? When we say it in the idea that they can create literally an infinite amount of dollars. And I wish
It,
this is where I don't know, maybe in postscript you can go back and add this in, but like that 60 Minutes episode where it's one of the
yes.
where he's like, I mean, he literally says the same thing.
Infinite.
This is the Federal Reserve, I don't know, New York or Kansas City or somewhere, and he's saying, yes, it is infinite, right? So they can create infinite money. That just doesn't make sense. It doesn't at all. When what is infinite
It,
in our world,
I th-
right?
God, that's
Go
it.
ahead.
Um, I think something that, you said what's infinite in our world, and I just went to God, and now I just completely almost forgot what I was going to say. Oh, here's what I was going to say. What do you get into business to do? Like, make a profit. You get into business to make money. Like, I understand it's to serve people, and yes, I agree with that. But at the end of the day, if you don't make a profit, you will not be in business. And so imagine a business that could just print profit. How powerful would it be for you to be in control of a business that prints the money? Like, if you just stop and think about that for a second, like everyone is in business, you go to work every day to make money, you're sacrificing your time, you're taking a risk, you're leaving your family, you could take yourself into financial ruin and poverty by putting yourself out there and trying to start a business, or whatever it may be. You could be fired from your job tomorrow. Your boss asks you to work late, or you don't get paternity leave when your son is born, or whatever it is. You're sacrificing your time and energy to go either make money from your job, from a business owner who is trying to make a profit, or you're the business owner taking the risk. You're doing that to make money. And now there is a entity that can just print the money out of thin air
No
infinitely.
work.
Infinitely. Like, do you not see something wrong with that? Like, I think that alone kind of just reveals a major problem. Like, if people truly just stopped and understood that alone, they'd be like, that's unfair.
Hmm.
At least that would be like the smallest emotional reaction. That's unfair. But people don't, because they don't understand it. And so this is why we're having the conversation.
Yeah. And to put some quantification around this before we get into this next part, so there's definitely many ways that we can measure monetary inflation, the increase in the amount of money. We at Strong Wealth, we just use the US M2. It's basically a measure of checking, savings, other liquid cash assets. And it's hard to get fully accurate, but the Fed publishes it. And so we can go back and see, based on this metric, the supply of money and basically in our economy at certain points in time. So if we go back and look over the last 20 years, which again is really that's the period since this stuff, this debasement, these methods, quantitative easing, have really ramped up. When we go back and look at that increase in the amount of money in our system has increased at an average rate of return, a compound annual rate of return of just over 6%. So 6% per year over the last 20 years. I think it was like 288% in total. That's the total amount when you compound that as 6.17 or something like that. What does that mean to you? That means that the value of every single dollar that you hold is getting cut in half every 12 years, if not more. Every 12 years, the value of your dollar is getting cut in half. That is, if we live a long life, that means the value of the dollar is going to get cut in half 6 or 7 times during our lifetime, right?
Mm.
And what we're saying with this mechanism, and maybe we want to go and explain that, is the most likely outcome of this whole system and this whole train that's going is that it quite literally is a snowball down the hill. and that it's not just like, oh, it's a just kind of linear growth. Money's just going to grow linearly over time. No, this monetary creation aspect is a exponential growth across time. And so
Mm-hmm.
most likely that 6% is only going to increase over time. So that most likely means that our money is going to lose value at a quicker and quicker pace across time. But even as it
Mm-hmm.
sits right now, over the last 20 years, that's what it's been. If you
Yeah.
go back and look over the last five, I didn't run the
It's
numbers,
40.
40%
It's
total,
it's it's 40 since 2020 alone. 40%
2020 alone.
increase.
So I don't know what that is compounded, but my guess
Yeah.
is that's higher than the 6% in the
Yeah.
last 4 years. Um,
Totally.
and so all we have again is, okay, so now your money's getting cut in half in 10 years time, 8 years time, the value of your money, right? That is the impetus for, okay, why do we need to, kind of reconsider what in the world we're doing, right? Because what happens, what happens with these effects when our money that we are, Mitch is just talking about, whether you're in business, whether you're an employee, whatever way you are expending your time and energy to go out and trade for dollars that are now getting cut in half every 12 years at least, what does that mean for you as an individual, right? That is the impetus for beginning to think about why we should consider alternatives, because there is a whole host of downstream effects of that,
Mm-hmm.
both on the individual and on society as a whole. I think the most
Mm-hmm.
common one people talk about is time preference, right? When our dollars lose value, especially that rapid of a rate, it changes our time preference. What is time preference? Time preference just basically go ahead.
I mean, we're gonna get into the weeds. I already know you're going down. You're going off the cliff down the rabbit hole.
All right.
Um,
So, I mean, if you want to come back up and talk about something else before we get there, that's fine.
yeah, yeah. I don't think that is really even for the downstream effects. Is probably um, for another episode. This is more maybe just lay the groundwork for something like that. But one other thing I think is important to touch on just how the system works is the Federal Reserve actually gives a license to banks to be able to print new money through loans. So if you do not have a license, you cannot be a bank. And those are issued by the Federal Reserve. So the Federal Reserve controls who can print new money. Okay, so that is why the few big banks got together back in the early 1900s. The J.P. Morgan Chase. I just went to Jekyll Island this summer. I should remember all of the names essentially that were on there. But J.P. Morgan, the Chase guy. I can't remember all of the other people. Um, but essentially, the big banks got together and they were like, "Hey, why don't we control the money?" And they were able to convince the government to allow them to do that. And so now they have the license to print themselves, but they also are able to hand out the licenses to whoever they want to print money. Like imagine you had a license to print money at your house, right there, right next to your desk. You just printed it out. Anyways, so that is like the ultimate, again, power and control that we're going back to, and why these powerful banks and the leaders of them wanted the Federal Reserve to be a thing in the first place, because they knew that, okay, if we have the power to print money, cool, and we can control who else has the power to print money. If it's someone we don't like, see ya. If it's a competitor who is maybe doing a better job than we are and has a better business, don't got a license. They wanted to have that control, and the government ultimately handed it to them on a silver platter. I think that's something that a lot of people don't recognize, is that banks don't just like, you can't just go, if you or I was like, hey, yeah, we're just going to go set up a bank. We can't do that. We can just
Yeah.
operate our own bank. I mean, there is private lending, I suppose, but we don't have the license to print. We're lending out our own money. The banks aren't. That is an important factor, I think, to mention. I think another important thing, we've already said it, but I think this may just really make it simple to understand. If I go to the bank and I want to buy a house, I'm like, hey, bank, I want to buy a house. Can I buy, or will you lend me money to buy this house? What we have said earlier is, or what the bank would say, based on the structure of how they were supposed to operate, is Jacob's already deposited money at the bank. I'm coming to the bank to ask for a loan. They will take some of Jacob's money and maybe someone else's money, and they will lend it out to me. Part of it. They'll lend it out to me, and they'll say, okay, we're lending this out to you. You owe us 5% interest, and then we'll pay that interest back to Jacob and whoever else. That's not actually what happens. The bank creates new money to give me a mortgage. It's not someone else's savings that they've worked hard for and they've trusted it to the bank, and they are like, I trust you, bank. You lend it out to people who are worthy and who will pay it back, and give me a part of the pie, or a part of the interest, and we'll have a great relationship. Keep my money secure, pay me some interest, and lend it out to people who are likely to pay it back. It's not how it works. It is entirely new money that comes into existence when I get a mortgage or I go to get a car loan or whatever else it may be.
And the perversion of that specifically, I tie this into FDIC insurance. FDIC insurance, so you open a bank account, you get, if it's just you get $250,000 of insurance. So what that means is that if you have less than $250,000 in that bank account, if that bank goes belly up, you will receive your money dollar for dollar, most likely. Not most likely, if it's under 250, you will. So what this means is that, so the bank is, going through this mechanism that Mitch just described, right? They're not even loaning out the money they have. They're creating new money and loaning that out. Now that works as long as they still keep some sort of money on hand so that, okay, they have enough to service whatever their depositors, us, need on a regular basis. And then the loans that they're loaning out also, okay, those work out for the most part, right? So that's why there's underwriting standards on loans. That's a whole different subject about that. But where, again, this is where we talk about this, okay, government intervening in free markets. FDIC insurance is the way they do this. What that does is it actually allows the bank to take more risk than they otherwise would. Because what is it incentivizing by putting this FDIC insurance on a bank account is saying, hey, we got you for your depositors that have less than this, right? So, because here's what happened historically. Prior to that, we've heard of, or we've seen. I guess we haven't seen it because I can't remember. Atticus. Doesn't matter. It's a movie. To Kill a Mockingbird, or it's a book movie. Atticus Finch talking about the bank runs. Like doesn't matter. Bank run. We all have heard of a bank run. What is a bank run? A bank run is that, okay, for whatever reasons, a whole bunch of depositors come back and demand their money from the bank, but the bank does not have that money because they've lended that money out, right? Mm-hmm. So that they have taken too much risk with the dollars or the monies that people have trusted them with. And so now they have a bank run, and now that bank is going to go bankrupt because they have demands on their deposits that they cannot service. So again, this is part of what led to the Great Financial Crisis and part of what led to the Federal Reserve in general. But now we've went so far the opposite direction. It's like we're not even lending out the depositors' money. We're just lending out new money. And then on top of that, even if we're taking risk with what we're doing there, the Federal Reserve is still going to step in and say, yeah, we got you. We'll just give all your depositors with less than $250,000 all the cash back that they have. So it allows the banks to go out and be even more risk-taking than what they otherwise would. So again, it is incentivizing them to take more risk because they know that the government will just step in and backstop them. Combine that, right? So that's the initial effect. Combine that now with quantitative easing, combine that with their other policies. It's literally, this is where you get the term too big to fail, right? It's quite literally is you get institutions that if they would go belly up, that it would wreak havoc on our financial system. And so, okay, what we've done, we talked about this earlier, is that, instead of having a fully free market, which along the way is maybe going to be a little more volatile, we've had this quasi-free market with government intervention with maybe a little less volatility. But here's the thing. It's not actually less volatility. All it's doing is pushing that volatility back and back and back. All that's doing is taking that volatility that would have happened, squeezing it down and saying, nope, we're just pushing that to some sort of future. And so this is where, again, we get to do too big to fail. Too big to fail is all that volatility we didn't realize before is now pushed in too big to fail banks and literally would crash our entire financial system. Instead of a free market economy where those banks would have been allowed to fail a long time ago because of their bad lending
Mm-hmm.
practices or whatever else. Yes, that would have sucked for those depositors. But again, this is where, again, it's not just the bank, it's also us as the consumer. If we can, go to a bank and say, hey, we actually have to evaluate that bank. And we actually have to say, hey,
Mm-hmm.
you bank, like, do you really actually have good practices or not? Like, should I actually be
Mm-hmm.
giving you my money, or is it actually safe there, or are you gonna, go and blow up, and then I don't have access to my money? It makes us be more prudent with where we put our dollars. So again, in the
Mm-hmm.
sake of reducing volatility, all we've done is make everything more haphazard on the back end. All we've done is, well,
Mm-hmm.
nobody cares where they deposit anymore. That's why the big banks get bigger, because that's okay. Why not? They have the best technology and whatever else. I can access them nationwide. And then it pushes us
Mm-hmm.
into this too big to fail realm. Okay, we've pushed all that volatility, and that is the part of the reason why the system has to continue and has to perpetuate, because now we literally can't allow that to happen. The government can't allow that to happen, because that really would be a horrible thing for a lot of people. It really would have a horrible economic impact and financial impact on a lot of people if we let the JP Morgan Chase fail, if we let the Wells Fargo fail, if we, whoever it is.
Yeah.
It's just like, this is, again, that's the perversion
Yeah.
of this system taken to the extreme, right? Like that's what it gets to.
For sure. For sure. I mean, if you just think about it as a business versus a business, the big bank, JP Morgan Chase versus us as Strong Wealth. We have to do things in such a way that our clients trust us, they pay us, and we offer a good service. If we do not do that, if we don't treat people right, if we don't, let's say we steal from our clients, or we're able to do whatever we want and it doesn't matter, we would fail. People would not pay us for our services if we sucked, or we were doing criminal activity, or we were doing whatever. But that's not true for these banks like you're talking about. They are a business, but it doesn't matter if they suck, because they don't answer to the customer. They answer to the Federal Reserve. They can go do whatever they want, because if it goes wrong, they can't fail. What you've said is the government the Federal Reserve will step in and save the day. So effectively saying, you can go act however you want. You can be as crazy as you want. You can be stupid as you want. You can treat people like crap, and it doesn't matter. Doesn't matter. If you are going to fail in business, we will make sure that you don't.
Yeah.
I think if someone heard that, they would be like, "That's unfair."
And it
That's
is.
how it works. I know. Like when you just explain it simply, it's like, how do you not think that that's a problem?
Hmm. Yeah.
And so this is why
And
people say the big CEOs, they should go to jail or whatever, the Wells Fargo's, whatever, like they should go to jail, because they are acting, they are doing business in such a way that is putting you and me and my grandma in harm. If my grandma has her money in Wells Fargo and they're going and doing all this crazy stuff to make more money just for them, the mortgage backed securities, et cetera, and now they have gotten themselves to a place where they're completely bankrupt. If they did actually fail, my grandma would lose all of her savings, be out on the street, poor. That's it. To me,
that's the
that's
pushing of
wrong.
the volatility. The pushing of the
Huh?
volatility. It's that's the
Yeah.
pushing of the I mean, it's literally like the what would be I can't come up with a good analogy right now. Like that's literally what I was getting to though is okay, yeah, things
Hmm.
were fine until they're
Yeah.
not, right? And then they're really not. But basically where we're at now, and again, this is where the system just perpetuates is they can theoretically just continue to allow this to happen. Okay, so the too big to fail comes across and okay, they're failing. Well, we're going to do whatever necessary to make it so they don't fail. What does that for the most part mean? That means that they're creating more money. And I think too one of the most perverse facts, if not the most perverse fact of this whole mechanism is of monetary inflation, of the increase of money, decrease of the value of each individual unit of the money, is that it is quite literally taking from the poor to give to the rich. I think people don't realize that either. It is literally when we create new money, especially at the scale that we're doing, we are taking from the poor and giving to the rich. Why is this? Right? Well, it's because the people who are close, and this is an analogy that breaks down a little bit, but it is true. It is because the people who are closest to the money faucet benefit most from the money faucet. The people who are farthest away from the money faucet stand to benefit the least from the money faucet.
Well,
And so
here,
what
I think here's one simple example just to drive that home is a poor person can't get a loan.
hmm,
New loans are one way of creating new money, and a poor person can't get a loan. I've worked at Schwab. I've seen this. The richest people get the most favorable treatment. They get the cheapest loans. They can get whatever they want. They can get all the new money that they desire. But the poor person cannot.
hmm,
That is one way because that is new money going to the rich person, and the bank saying, "I will not lend to you, poor person." Boom. And that new
and
money,
it's
then you can take it the rest of the way. But that new money that went to the rich person, what does that then do to the poor person?
right. And this is like I know you're in the same vein here, Mitch. Like we're not trying to rail against rich people, right? Like there's a reason that this mechanism happens, and it's not necessarily that the person themselves are bad or that it's bad to be rich per se. That's not where we're trying to get at. I mean, from a faith perspective, with a person of wealth, you have to be very much more mindful of that wealth and the spiritual impacts of that wealth than maybe what a person who doesn't have money does. I mean, you can take it both ways, but so there's those impacts, right? But notwithstanding
Mm.
those, it's not like, they're doing anything wrong. What we're saying is that that isn't fair. And life isn't about everything being equal. Like, okay, the person who makes less, then yes, they likely can't get as much as preferable of rates on loans or whatever else. But to the point and to the extent in which it is happening is where it becomes unfair, right?
Mm.
And to further even more this point is okay, so new money is created. What are the effects? Okay, so the rich people have new liquidity and they can go out and either take more loans or they already own assets that are going to benefit most from those. So they own stocks, they own real estate, they own equity in a private business, a large private business, whatever it is. Those businesses, again, because part of the principle here is when more money comes into the system, that means that basically because there's more money, everything just grows in value. Now it's nominal value, not real value. The nominal value just meaning the dollar amount goes up, the real value is still the same. Anyways,
Mm.
they own these assets that are okay benefiting from that because that money has to go somewhere. It's going to go to those first because those are those financial assets are closest to the monetary spigot. The person who does not own any assets is living paycheck to paycheck. What's the effect on them? Well, here's the normal effect. Prices for things go up faster than what their wages do. That's one effect. So again, this is where we get to it's literally taking from the poor to give to the rich. Because now the poor person is in an even worse space than what he was before, and the rich person is in an even better place than what they were before. The poor person has to again literally
Mm.
squeeze their financial margins even more. Their wages are not keeping up with the increase of prices over time. So that just perpetuates their poverty. That's all that does. That it
Mm.
just continues to perpetuate that. Now, we're never going to get rid of poverty. Sometimes poverty is a good thing for some people. Not necessarily everybody, but some people actually should experience a season or I don't know, whatever of monetary poverty. Like it's good for the soul in some ways.
Mm-hmm. Yeah.
That just notwithstanding, um, that mechanism that is what happens every time more money is created. And again, what we're saying with this whole thing is that this money creation mechanism is a snowball down a hill. And so rising wealth inequality is a hugely talked about topic, right? But many people, again, it kind of gets to they don't necessarily understand what the root cause of it is. The root cause is new money is created. It's going to be created at a faster and more rapid pace. That means that inequality is going to become faster and more rapid. And those who own assets, specifically financial assets, are going to continue to benefit more and more and more versus those who do not own those. They're going to be worse and worse and worse and worse off because of how this plays out. And so that's where it gets to from a moral perspective. People like to take morality out of money, but at the end of the day, money is nothing but morality, in my opinion. When we look at that from a morality perspective, it's like, is that a just form of money? Is that justified? Is that allowing both the rich person and the poor person to be dignified in the way they live their life? Absolutely freaking not. That the rich person is unjustly benefiting from something that they have no control over and did nothing to earn, and the poor person is unjustly getting penalized for something that they did not do. That is what this gets to. Is it is an immoral financial system. and that's why I think that I'm getting just worked up on it, but like that's what I think this gets to. That's why people like to rail against the Bitcoiner on at least on social media, and that's fine. You can do that, and a lot of it is honestly well deserved. But this is a lot of what it gets to is that it's not just like Bitcoin is a fun way to make a bunch of money, to get rich, do whatever. That's how a lot of people come to this. But once you start to understand, again, this is why Mitch, he reads the fiat standard and it's like, this sucks, and this is why. Is because it really does. And again, this is where it gets into more of those sort of downstream effects that, if we want to save for another day, that's fine. But that initial one, that it benefits the rich at the expense of the poor, that is what monetary inflation does. Like, that's just something that I personally can't stand for. And so it's like, okay, well, but prior, we didn't really have an option to do anything different. It's like, well, either rail against it and don't do anything, or don't rail against it and don't do it. Like there is no other option. Bitcoin, it gives us optionality, and this is where it gets to. Bitcoin may not be perfect. Bitcoin is imperfect. Bitcoin is not the savior of all. Bitcoin has things that it very well could not work out, but what it does present is an alternative framework, an alternative system to the current one that is more just. And I've said that before. Bitcoin is a more just form of money. And that is a good thing. And that is something that is worth fighting for. That is something that's worth perpetuating. It's not that we need everybody to be equal. We don't need, everybody's got the same, there's no rich people, there's no poor people, everybody's equal. What we do need is we want the individual to be a dignified person. We are created in the image and likeness of our God, our Lord and Savior. That gives us inherent dignity. When we start to take that inherent dignity away, okay, like that is not good. That is not right. But if we have a mechanism in which we believe can give that back to that person, to that individual in some form, fashion, and sense, then let's go freaking run at that as much as we can. Let's perpetuate that as much as we can. So I'll get off my high horse.
No, I mean it's true, and I hope people hear it and actually understand what you're saying, because it is a big deal, and I think it's also very. I think it's also why we prefer to work with people that are generous. and we encourage generosity, and we want to be generous, because at the end of the day, we understand how, we are financial advisors. By definition, we are going to work with people who have more money than who don't. And so if we can encourage, we can help the people with more money understand this system and leverage it in some ways, also opt out in other ways. We prefer to completely opt out, but at the same time, we can see clearly, and this is where other financial advisors cannot. They don't even understand what you just described. They don't. They may have these strategies or whatever that they think, but they don't understand the system as a whole. And so us being able to see clearly the current system, how it can be leveraged effectively, or how we could opt out and go to this new system, Bitcoin, is very important. And in my mind, is a no-brainer to work with somebody who can understand it all the way from top to bottom. Because, and then to tie this back into the generosity, if we help someone leverage the current system that you're describing that we believe is immoral, well, we believe to pay that back through generosity. Like, it can perpetuate it in some, form of the word, but okay, if we are at least using that to then benefit the poor, pull them out of wherever they are, as much as we possibly can, that makes this even more important.
Yeah.
Because
Yeah.
if
I
we're
don't
going,
even say that's the thing. Was like, it's not like this. Again, it's not like this. We gotta give the poor all the money or give
for sure.
eradicate poverty. We're not going to do that. No, that is not the premise. The premise is that because it's immoral and because it's an unjust money, that is not allowing them to live a dignified life and a dignified person as they should be able to, versus a system that is moral, more just, at least grants that possibility more than what our current system does. It doesn't guarantee it. It doesn't mean that it's going to fix it, but it at least grants the possibility more than what where we are at right now. And that is a net good. That is where the part of the net benefit of Bitcoin can be to society as a whole.
Yeah. 100%. 100%. And I think this is honestly just a good place to wrap it up. We can get into the downstream effects of all of this stuff, in a later episode. But it's just very important, and why we went from what is money. We have to understand money first before we can really get into the current system. It's why we jumped from what is money to our current financial system. Because if you don't understand what money is, and then you don't understand how our current financial system operates, you're not going to be able to then understand the revolutionary capability of Bitcoin. It'll be something cool that you hope you buy it and the number goes up, and you make more dollars. But it's much bigger than that, and that's what we're trying to explain here, by laying the groundwork and the foundation, to be able to then say, oh, okay, well, this is how Bitcoin can fix things, or at least gives you the option to opt out and not be a part of what goes on with our current financial system. So,
And I think one point that I don't think we've said it all, and it's not a big one, but
okay,
I think one point that
sure.
is worth mentioning is that this system, Keynesian economics, this whole monetary inflation thing, that we're not unique in the modern era. The United States is not unique. I did say that most every country is utilizing some form of this, but also this is why we've seen more hyperinflationary events, why you can have a $1 billion Zimbabwe dollar, why we've seen more
Yeah.
hyperinflationary events since the United States went off the gold standard, because many other countries followed, and many other countries, even if they didn't, are tied to the US dollar. We've seen more of that in the last 50 years than at any period before that. And again, that's because all that is that those countries, their snowballs, they just built faster and they rolled farther. Now the United States, I mean, that's the thing. Hopefully we never get to the point where we really reach that with the US dollar. That would not be a great position. There's many other ways that things could happen. But like, that mechanism, we're in the United States is not unique. It's not like, oh, we don't know what comes next. This is all no, this has happened. It's played out in many countries. That's why you see this. That's why you see people using money as toilet paper or for fire. It's literally
Yeah.
worthless. That is
Right.
that is the end game of all
Hmm.
the basically of all fiat money as we know it now, when it is no longer tied to reality and can be created infinitely at will without any work at a press of a button. So
Yeah.
I don't. I think
By
that's
people
important.
by people in power who have their own personal interests. Um,
Mm-hmm.
and we could also go into how we actually cause the other countries for their snowball to go bigger faster. We force that to happen by putting them into debt. So
Yep.
that's again another downstream effect of, we're putting these societies into financial ruin, which then causes them to have to print their money faster to try to pay off the debt back to us. And then they get hyperinflation, and then they get into war, and then we have children and grandmas and babies die um, because of it. So, anyways, that's again more,
Downstream, episode
yeah,
3.
maybe we'll see. But anyways, if someone listened to this all the way through, I think they will understand, one, how our financial system works and why it is bad. But one other just point that I want to drive home is this is why it's important to have someone guiding you financially that can see this, knows how this works, understands this, but also has the foundational values that we have. I don't care if you're Christian or not. You can believe in the Christian values if you don't believe in Jesus Christ. Okay. We can have a conversation about that. But at least anyone, even if they don't believe in Jesus, they can support the Christian values. Like, I think everyone would support the values that, we live by. And so it's very important to have a person leading you, a financial planner, advisor, that can see this clearly and can also keep your foundation steady. Like, I don't know how you would listen to an hour and a half of us talking through this and not see how that is important. So I just wanted to drive that home. And this is why we're doing what we're doing, because we do see this, and we know how to exploit it, we'll say, or opt out completely with Bitcoin. And only reason why I say both is because we're really taking people down the path, all the way, to eventually see it how we see it, hopefully through education, and help, and that allows them to help their family in the best way possible, and their community in the best way possible, and their state in the best way possible, country, etc. So yeah, I just wanted to drive that home, really, to sell ourselves, but I'm not afraid to sell ourselves because we're doing things the right way. And if you've listened to this, you can understand why that's important. So, anyways, thanks for listening to us ramble on. Hopefully you got some good nuggets out of this. Hopefully you have some understanding of how our financial system actually works, not just what they say, but how it really works. And if you have any questions, of course, you can always send us an email. I don't think you can comment on podcasts. I don't know. I guess you could leave a review and ask a question, but send us an email. My email is mitch@strongwealth.net. You can shoot us an email, or you can find us on social media. I'm at Mitch D. Moore on everything. Jacob is at COLBITRUN, at COLBIT. Yes. So COLBITRUN. You can feel free to send us a message, ask any questions. We'll be happy to answer those for you. And just appreciate everybody listening. If you wouldn't mind, please share it. If it was like, man, this was really helpful, I got a lot of value out of this, please share it with somebody else who we can also help. We'd really appreciate that. And we'll see you in the next episode.